Hello, everybody. In this session, we are talking about financial performance. Financial performance is a subjective measure of how well a firm can use assets from its primary mode of business and generate revenues. The term is also used as a general measure of a firm's overall financial health over a given period. Analysts and investors use financial performance to compare similar firms across the same industry or to compare industries or sectors in aggregate. And then we move to the key components of financial performance. The first component, revenue, the income a business earns from its normal business activities, typically from the sale of goods and services to customers. And then the second, liquidity, its ability to quickly convert assets into cash to meet short term obligations. And then the third, profitability, the company's ability to generate profit from its operations and what percentage of sales this profit represents. And then fourth, solvency, the company's ability to meet its long-term debts and financial obligations. Fifth, cost structure, operating costs, including fixed and variable costs. And then the sixth, cash flow, the amount of money coming into and going out of a company during a given time period. And then seventh, assets, financial resources the company owns that have the potential for future economic benefits like cash, property, inventory, etc. And then eight, liabilities, obligations or debts a company owes to extant parties like loans, account payables, etc. To assess a company's financial performance, stakeholders, creditors, or potential investors will look at their financial statements. From there, they'll dive deeper into the numbers to get a sense of how it's doing and doing and where it's headed. And then, why is it important to measure financial performance? It is important to measure financial performance because the analysis will allow you to first assess the financial health of your business, determine whether your operations, revenue, and profits are on track to grow. And then, second, communicate financial information to stakeholders. Your financial performance lets you and external parties in make intentional, well-informed decisions. It's very important. And then the third, monitor performance. You can identify trends and potential problems before they happen. And fourth, identify areas for improvement. If you're experiencing low profitability or cash flow problems, analyzing financial performance can help you pinpoint the causes. And then, what are the types of financial statements? There are different types of financial statements that analysts use to gauge the financial performance of a company. The first, balance sheet. Think of the balance sheet as an overview of a company's financials on a particular date and how effectively and it is managing its assets. The balance sheet provides information on the different kinds of debts a company might be in, like both long-term and short-term debts. Apart from this, the balance sheet also gives analysts might insight into the different kinds of assets the company holds and what percentage of those assets are financed through debts and capital provided by the stockholders. And then the second, cash flow statement. The second type of financial statement is the cash flow statement, which can be considered a combination of the income statement and the balance sheet. This combination is what makes the cash flow statement one of the most important statements for certain analysts. With the help of the cash flow statements, analysts can analyze how much a company spent on repurchasing stocks, dividends, and even its capital expenditures. And then third, income statement. The third type of financial statement is the income statement. The income statement is a concise list of all the operations of a company in a year. The statement starts with the revenues of the company and concludes with its net income. The income statement is also called the profit and loss statement, as it also gives insight into the gross profit margin of the company along with the value of the goods sold. The net profit margin and the operating profit margin. To add to this, the income statement also provides details about the number of outstanding shares as well. And then, what are the key financial performance indicators? The first, gross profit or gross profit margin, measures the profitability of the company is core operations by subtracting the cost of goods sold from revenue. Gross profit margin is expressed as a percentage and indicates the efficiency of production and pricing strategies. And then the second, return on assets, or ROA, evaluates the company's efficiency in utilizing its asset to generate profits. Return on assets compares net income to total assets and indicates how effectively the company employs its resources. And then the third, net profit or net profit margin, reflects the company's overall profitability after deducting all expenses, including taxes and interest. Net profit margin represents the percentage of revenue retained as profit and signifies the company's efficiency in managing costs. And then fourth, inventory turnover measures the efficiency of inventory management by calculating the number of times inventory is sold and replaced within a given period. Higher turnover indicates better inventory management and reduced risk of obsolete stock. And then fifth, working capital measures the company's short-term liquidity by subtracting current liabilities from current assets. Adequate working capital ensures smooth operations and the ability to meet short-term financial obligations. I think it is enough of this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe, and share. Thank you.